Welcome back to Inside Story. We're talking about the financial crisis, its impact in the United States and around the world. And joining me are Ken Goldstein, Ravi Bhatia, and Gregory Larkin. Greg, you were talking earlier on about the subprime mortgages that are being held in some investments right now. What happens to those?
Well, currently those are marked down by about 80%. And I would actually think that's an aggressive mark. I think they're probably going to be worth more than that over the long run. The reason being is that some of the subprime mortgages, and unfortunately a huge proportion of them, are of the toxic variety, meaning that the income was stated, the structure of the mortgage was essentially predatory and designed to collapse, and that's part of the mortgage market. And then there's the other stockpile, which is fixed rate, healthy, transparent, fully amortized mortgages. Those are going to be hurt, but okay. And that's a viable business model, and I think we're going to see a huge concentration. The subprime mortgage market isn't going away.
Ravi, do you believe that the subprime mortgage is not going to go away?
I think it may be called something else, because using the word subprime is not going to be too palatable to everyone, but it'll be called the lower end or the higher risk. So that will, there'll always be some kind of gradient. But I wanted to add to that the way the industry is structured is that mortgage brokers, mortgage banking has been basically unregulated, and there is no incentive for the mortgage banker, not to do a deal. They do a deal, they get a fee. We have a fee-based system, and whenever you have systems that are fee-based with no incentive, or really there's nobody to come back and hold them accountable, they walk away, they get their fee, and now the banks are held liable, and the person who took a mortgage that they may or may not have been, fully aware of. A lot of people are now pointing fingers, but where's the mortgage banker in all this? I'd like to ask that question.
And I think one of the changes we're definitely going to see, and it's remarkable that we deviated from that in the first place, is that banks are going to have to focus on getting their loans repaid. Now, it's amazing that that's new, but that's where we are. What's going to have to happen is a shift, and it's going to be a messy shift, and there are going to still be scalps. Which is that when you extend credit, the objective has to be to get the money back rather than to close the deal and collect a fee.
You laugh there, Ken. Is that a pipe dream?
I don't disagree with that, but I think that if we look at the bigger picture, I think if you look at, what's finance supposed to be doing? That basically it's an industry to take our money that we've saved and put it to work for us so that when we retire or our children go to college, that the money's going to be there. I think that we got a little bit away from that, and we had the finance industry, sure, managing our money, but more concentrated on managing their money. Again, back to the securitization, back to this leveraging. And so I think that whether by design or by actuality, I think where we go forward, once we get over this, and we will get over this, but we'll sort of get back eventually to a finance industry that's more focused on managing our money than managing theirs. I would want to make one last point, and that is, while we're talking a lot about the United States, this is a global situation. Absolutely. This is happening in London. This is happening in Frankfurt. This is happening elsewhere. Because in this more globally connected world, finance, in fact, is probably more globally connected than any other industry. And so in some sense, this crisis really comes about not just from some excesses domestically, but really where finance has been going over the last decade or so. And I think that these changes, they won't just be in the United States. In fact, we're seeing changes elsewhere. For example, one of the things that they announced over the weekend, over the last 48 hours, was a limiting of short selling. Yeah. Well, other markets have also done the same thing. In fact, a few markets have just outright declared that you can't short sell, period. I don't know that that's a good thing. I don't know that that's a permanent thing.
You can't do that permanently.
I also think one of the problems, and it's a recurring problem, and this won't be the last time we see it. We saw it in the dot-com boom. Something about investment banks makes it almost impossible for a banker to leave money on the table, even if they should know better, that the long-term risks of taking and plunging into that opportunity are going to erase any gains in the short term exponentially, like ×4. as long as one other bank is getting rich in one business, every other bank will try to get into that same business. And if it's subprime mortgages or overvalued tech stocks or coal or what have you, we're going to see this again.
But if you take your point, it's not the bank, the institutional bank that's doing that. It's the people who are investing in the institutional bank, almost, at least from their point of view, forcing them to take this point of view.
Absolutely.
So if you come back to your first question that we started with this session, who's to blame? We are.
Well, there was another view as well. The Financial Times had a story this week in which it said that no, Alan Greenspan was not to blame because of low interest rates, because low interest rates were needed at that time to prevent a recession and to stimulate growth. But what he is to blame for was creating what they call a speculative bubble. Well, gambling by any other name.
Look, you can blame the Federal Reserve. Actually, again, you can blame central bankers, not just the Federal Reserve, not for going so low in terms of interest rates, but perhaps keeping them too low for too long. That's a fair criticism. But the other thing that Greenspan, and he wasn't the only one, he might have been the first one, was also telling us as early as 2003 that risk premiums, bond yields, were not fully pricing in risk. So, while we might lay some blame on him, he also was sort of Cassandra, letting, sounding the early alarm bells. Who knew it would be this big a problem? But, if we want to give him some blame, let's also give him some credit for being one of the few and the early one to suggest to us we've got some problems ahead. And it turned out we sure do.
I do think, though, that if there's any blame that can be allocated to Greenspan, it's because this is a problem which seems to be surprising to him. And it happened, the grounds of it happened, let's start and say 2000, 2001, that there was this market, which is different than, I would argue, different than the dot-com bubble, because it actually involves every American rather than people with a computer science degree. And I think this surprised him. This was something which he thought was fundamentally healthy and wouldn't erode confidence and wouldn't crash. And this is a surprise to him, and I think it shouldn't have been.
We tend to always look for blame, and I think it's more important for us to look at the future and
Sure.
look at what we can do to improve things, and so this does not happen again. I'm also very concerned, and in economics, things always seem to work in pendulums. I think the pendulum now, because that's I guess that's really what everyone has on their mind. It's going to go so towards regulation that we will change the fundamental nature of risk and return, which are important to the system that we have, the system that depends on entrepreneurship and innovation. And if those two things are thwarted, I think the cost can be much higher than we anticipated.
I don't know that the pendulum is going to swing from too little to too much regulation, but I do think an important point was raised, and that is that all of what we have seen, not just in the financial market this last week, but what we have been looking at for the last more than a year, we have never had these set of circumstances before. This is uncharted territory. And so maybe the largest question of all is this a unique event that nobody will ever see again? Or could we be back here in 10 years? And I think what regulation we might wind up with is the kind of stuff that might prevent getting back here anytime soon. I don't know that that's too much regulation, but I think that we'll see some.
I just want to look at one final point on the program here, and that is the public perception of this crisis. The public perception seems to be these were a bunch of guys who made loads of money and ran off, and now we're picking up the tab.
Part of this really goes all the way back to the dot-com bubble. While this is different, it's related in the sense that, we were lied to in the dot-com bubble. In a sense, we were lied to. Nobody told us that this was going to happen. Nobody told us that this could happen.
There's an interesting topic that was triggered yesterday. A friend of mine who's a leading guru on innovation and technology management at Polytechnic in New York, he sent me an email and he said that when we think of all what's going on with the regulation and the government stepping in, he said it looks as if, to the public, that we are trying to privatize the profits and socialize the losses. And that's a perception that you can't shake easily.
Gentlemen, that's where we're going to have to leave it. Thank you very much for joining us.
Thank you.
And thank you for watching. We welcome your comments and suggestions. Please email them to us at insidestory@aljazeera.net. Goodbye for now.